Good morning, everybody. Welcome to the Locking Your Success Options Trading for Income Weekly Update for May 19th, 2014. While I'm thinking of it, I just want to mention that next Monday is Memorial Day, and therefore there will be no live webinar on Monday morning. What I'm going to do instead is I'm going to do a recording like I used to do before the webinars, and I'll post it on the website at lockingyoursuccess.com. And I will do that definitely before Tuesday morning when the market opens, but probably Sunday night. It's going to depend on my schedule over the weekend. But you will get an update. We're just going to be doing it from a recording rather than doing it live. All right, that said, let's get moving and go over our disclaimers and just let you know that the seminar is given for educational purposes only. We're not broker-dealers, and we're not financial advisors, and we're not making any specific trade recommendations. Also, the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And please note that we do use hypothetical computer-simulated trades in the presentation, and we do the best we possibly can to make sure the results are represented as accurately as possible. However, there may be a difference between live results and your actual fill prices. If you're watching this on YouTube or some other venue, please come on over and visit our website. Check out our programs, the M3, Bearish Butterfly, and Rock, as well as the new M21, and take a look at our group coaching and the Trading Triangle program. Please join our mailing list and get your free reports, the 7 secrets to becoming a successful trader, and sign up for the weekly webinar. And stay tuned for what we have in development here. We have the SSS trading system series coming soon. I'm working on a Trading Triangle book, which will be very helpful in your options trading when that comes out. And we have a lot of other things in the pipeline as well. Let's take a look. Well, first, before we get going, I hope everybody made the transition okay over to the new webinar series. This is going to happen probably once every 3 months. They only allow me so many webinars, and then I have to renew. So I just plan on that. All right, let's take a look at the market environment and what's going on. If you remember last Monday morning at the update, the Dow was bumping up against its all-time high resistance area. And we're saying because the futures were up, it was probably going to exceed new highs and very likely to close in all-time high territory, in which case would be a breakout for the Dow from this range we've been keeping. But at the same time, I was also saying that in order for me to take this seriously and think about the market's actually going to go up, that I would need some confirmation from the SPX. And the confirmation would be that the SPX would break to new highs and hold. Well, the breakout day only put the SPX up to its resistance point. We had a slight penetration into new highs on Tuesday, but the market immediately backed off and closed back within range, and we backed that down again. So that being the case, the expected movement at that point would be a move down in all the indices to their primary support level. And I was thinking that the SPX primary support level would be in this area here at the 1850 range. The pullback we got was quite a bit less than that. If you look at the Dow, this did actually, when we had our support break here on Wednesday, we did actually come all the way back down to our trend line, so that pullback was somewhat normal. But the pullback in the Russell came pretty close down to its primary support here, the 1075. However, the NASDAQ barely pulled back at all. So if we come back to the NASDAQ, we have a situation where we did pull back to a kind of an uptrending support area, but this is very, very minor. So what I'm trying to say here is I was expecting the NDX and the SPX to pull back deeper than they have. That being the case, because they didn't pull back as deep as I thought, that gives us a bit of a bullish bias for those indices, where we have more of a bearish bias for the Dow and the NDX. And this keeps us pretty much where we've been for the last 3 weeks, where the market is just giving us completely neutral signals, and we really don't know where the market's going. It's kind of a flip of a coin, because I could really build a case for the markets going up. I could build a case for the markets going down. That said, the short answer leaving us very neutral at this point. If I had to choose the most likely move of the week, I would say that if we shoot over to the SPX, we're likely to break down to probably this trend line area down here, or at least these lower lows at 1850. That's going to be a 30-point drop for the SPX. That's going to equal usually a fairly decent drop for the Russell. And that will definitely pull us down if that happens. It will definitely pull us down at least to our 1075 area. So that is what I would say would be the most likely move, and I wouldn't even be surprised to see it pull down to our more primary weekly trend line in red here, back down to the, around the 1060 level. Certainly wouldn't be out of the question. That actually coincides quite well with this. Actually, let's make a box here. This whole area should really act as a support area for the Russell, and it could really roll over anywhere in this white box and be completely normal. So even a break here of these lows would probably make a violent fast move, but probably only down to around this level here, around 1065. And I would expect the markets to bounce from that point. So that is what I would say is the most likely move. But again, it's a flip of the coin. The markets aren't very readable right now, which is actually really good for us because being in market neutral trades, we're a little bit volatile in the Russell. But a lot of the other indices like the SPX is very, very flat, and the NDX has been very flat as well, which gives us a really good environment. And in the Russell, other than being a little bit volatile, this is a good environment also because we're not getting these excessive large moves. So that's what I'm thinking of the market going forward. And let's and if we get a breakout from, again, if we get a move up and the SPX breaks out and the Dow hits new highs again, then that's going to be bullish. I'd expect everything to pull forward. If we get any sort of a major support break in the SPX or the Dow, it's going to be really ugly for the Russell. But for now, like I said, we're still very, very sideways. Let's take a look at our positions here. Because the market has been so sideways, there really hasn't been any adjustments whatsoever. So all I'm going to do is I'm just going to come in here and we'll go over all the positions that were open. And I did open a July deconder. We'll go over that and kind of tell you, what we have for plans with certain market moves. So this is our June deconder, which has been on for quite a while. If you take a look at our analyzed graph, this is what it looks like here. I will this is a very wide position because the volatility is up. And I'll just widen this out a little bit so we can actually see just about the whole graph. Here, we're a little bit to the downside. This trade really doesn't have too much of a concern if the Russell comes all the way down to 1065 where we think it might go. It may trigger an adjustment, but it would only be very minor. So we're really not concerned about this at all. The biggest concern here is the market hanging in this 1130 area and just kind of sitting here. In which case, if it does do that, we'll start pulling out the V. But for right now, we've really not much to do here. Let's take a look at our M3 for June. Here's what this position looks like, which is completely the same as last week. We're at the 1080 shorts. We had a pullback last week. It put us a little bit positive delta. We really never saw any sort of adjustment. We have our long call at 980. Currently, the position's up about 23.2, which is almost 5% of our planned capital, much more than 5% of what we actually have invested in the trade of about 25,000. And this is looking perfect. We're starting to get that sag because we're getting closer to expiration. And all that means is the delta is going to go negative a little bit faster, and when it does, we'll start putting verticals in. But as of right now, the position looks perfectly fine. No plans to do anything to this until we get under 1080, and that's towards the end of the day. Or if I don't imagine there'd be an adjustment under 1120 this week. It's possible. If I'm over 50 delta at 1120, I will make a vertical adjustment just to kick that forward. But more than likely, we're just going to stay in this position here. The next trade we have going on would be let's see, a bearish butterfly for June. This position currently is sitting right at the short strikes. We have 1,100 short strikes. No adjustments at all since this has been put on. And the position is up over 10%, about 68.30. We have our analyzed graph, which is sitting nicely right in the middle of the position here. A breakdown to 1065 would mean nothing to this. It'd be actually good for it. And of course, if we take off, the only issue we have is we take off really hard to the upside and we get an extended move to the upside. It's becoming increasingly vulnerable to a move like that. But as of right now, everything is good. And like I said, we're just following the guidelines. No adjustment points here until under 1060. Or what we're going to have is we're going to have a delta theta problem probably if we get enough, and we'll probably end up rolling this forward and then adding. We'll end up rolling this to 1120 and then adding 1140s most likely if the market moves up. So that is this position. One of the things with a bearish butterfly that's only entered 1/3, normally, and this actually is not in the guidelines, but from a practical standpoint, if I get up 10% of my planned capital, which in this case is going to be $10,000, what I'll normally do is just pull the position off and just treat that as a win. The reason is because the total capital in this trade as it sits is only $93.70. And if this gets up to 10,000, I'm looking at a 100% gain on my invested capital. And I'm also looking at a high gamma position. I think that's plenty for the position to make in that situation. And there's nothing wrong with a 20% gain in planned capital either. So that being the case, I'd be perfectly happy to pull that off. We'll see if that actually happens. Probably won't happen this week, but it may certainly happen next week. That's all we had open as of last week. I did open a V condor for July, and we did that on Friday afternoon. This position here is not shown. Let's see. Well, I'll show you what I opened, and let's just make an example of this now. I don't know. Maybe I didn't record it. I thought I did. So anyway, V condor. If I'm going to be, oh, okay. Thank you. I opened January 14. January looks like July. All right. Let's see. July V condor. Hey, that's better. All right. So we opened these up at what was approximately 10 delta at the time. We had 990 puts. We had an 1100 put. Actually, this was open on Wednesday with our T-log. That was actually 65 days to expiration. So we opened this on Wednesday. We opened with the 990 shorts, 30-point wings as normal, with the 960 longs. At the time, this call was 10 points under the. This put was 10 points under the money. So we have 1100 put. We have an 1100 call, and we have short 1200 calls and long 1230 calls. This is what the position currently looks like. Should take a fairly big price movement. So I'm really happy with this position this month. And that's all the trades we have on for now. Yeah, thank you, Keith. He's telling me it's normal. It happens more as I get older. Yeah, I know. It happens more every day. So we're trying to do that. Okay, great. So that's all the positions that we happen to have on. And like I said, not a whole lot of excitement. The market's been so sideways that we haven't really had to do anything. Very good for our trades, a little bit boring for the updates sometimes. Does anybody have any questions on any of the trades or any other things this morning? Okay, do I think it would be safer to scale into a June bearish butterfly as a rock rather than a bearish butterfly? So I think what Andrew is asking is, I have this position on that is a June bearish butterfly, so let's take a look at this. Would I rather see this as a rock trade if we get an up move? And that is certainly not a bad question. So, and we kind of went over this in group mentoring a little bit of taking one of these and making it into a rock trade. So that's a good idea. So at this point here, we have a let's see, we have a delta. If we're doing it if we were going to do an entry test for a rock trade, for example, we look at our delta at 1120. We'd want to be over 180. Currently, this does not meet the requirements, the delta requirements to trade it as a rock trade. So the answer would be no. I probably wouldn't want to do that. You know what I would be more interested in doing with this trade if I was going to adapt it is to go in with M3 guidelines to the upside. So the market starts taking off to the upside. We're looking for around 100 delta, which is going to appear at around 112. We come in here, and so we're not adding a call yet or anything like that as far as right now. But what we're going to use, instead of using delta guidelines that are associated with a bearish butterfly, we can take this 1/3 and use delta guidelines that are associated with an M3 trade. And when we start getting to 100 delta, we can start kicking this back, kicking our delta back down. So in this case, market goes to 1110 or 1113, right in this area. We come in with maybe like an 80 delta call to, well, maybe an 86, right, to level it off so that when we actually get to here, we flatten ourselves out again. And then we start to use M3 guidelines to the downside, and then to the upside. As this market starts going up, we start using verticals to keep our delta within M3 guidelines, and then you're completely in an M3 trade. And you might be able to get maybe another 5 to 10% out of this without really risking taking this big loss if the market moves up significantly. So that's probably what I prefer to do rather than a rock trade. And then if we get up a certain amount, depending on how fast, if we have a nice fast up move, then I'd be interested maybe in converting either back into a bearish butterfly or maybe even a rock trade. All right, so another question is, go over again when I would take off my June M9. I take it off 21 days to expiration because that's the reduced profit guidelines. I'd also take it off, if I'm just going straight M9 guidelines, if I hit 20% of my planned capital, which is a $10,000 profit, and I only had 1/3 of my position on. Usually I'll take it off. I mean, I just think that that's and you'd be about over 100% of your invested capital. That's a good trade, and I'd probably take it off at that point. All right, can you tell me more about my book? Okay, so the Trading Triangle program, I do have a video on the blog about the Trading Triangle program, which when we come in, we talk about your psychology, your goals, how to pick a trading system that's going to work for you, how to develop a system that's going to work for you, and then we go also into how to set up a trading business. So that's one of the biggest things that's really not taught in this industry is if you wanted to go out and you wanted to retire or switch careers to become a trader, how much money do you really need to make a certain amount of money? How much of your actual capital can you trade with? How much do you have to put aside to rebuild your account and to deal with repeated months of possibly flat returns or any other thing that may happen that may draw the account down because if you're not making returns, you can't draw your salary out of the account because that reduces your account size, and of course, then that reduces your income. So it becomes a vicious circle. So it's essentially how to take a trading business, properly capitalize it, properly plan, so that you can survive long term in this business. Just because you're a good trader doesn't mean that you can retire and be a trader. It's just like anything else. Just because you're a good auto mechanic or just because you're a good lawyer doesn't mean you're going to survive opening a law practice. There's a lot of business aspects that go along with it. You need to know those, and you need to know what you're getting into before you actually open a trading business to make sure you're going to survive. So that's a lot of the stuff that is going on with the Trading Triangle book. All right, next question. I mentioned possibly adding verticals to the M3 before it got past the long strikes to the upside. Is that because we're closer to expiration? No. That's typically what I'm going to do to an M3 if I start running into a problem with delta. So if I had if I go back to the M3 trade, take up this call. If I run back to the June M3 website trade, This here, I have a couple concerns here, right? First is, I mean, where I'm positioned right now, there's really no problems. I am getting some steep gamma coming into this trade, which is going to happen if the price stays at this level. You're going to start to get steep gamma. At some point, you may want to correct it, and you may not, and there are certain ways to do that, but that's not the question. The question is why would I add a vertical? Well, as this gamma gets steeper and steeper, I'm eventually going to hit my maximum delta guideline of minus 100 here. And if you're within the program, another thing you're going to find out is that the worse this gamma trend is, or the drop-off is to the upside, the more concerned I am about my delta. So rather than waiting to go to 100 delta, particularly if I start to get near the edge of my tent, or if I get up in the 75 range, and I'm actually anywhere in this area where the blue line is right now, I'm going to tend to want to start to flatten this out a little bit faster than normal, in case the market, because the market's been down for a while, and of course we get a breakout, we'll get a strong move in the Russell to 1160. So to predict against that, I'm going to want to try and stabilize my T+0 line out here, and I will do that with verticals. That will create a delta protection that I want, but it's also going to help stabilize my T+0 line out here, which is why I would put the verticals in there. All right, next question is, for the V Condor setup, what is the smallest capitalized size you can put one on? So for the V Condor capital size, we're showing them at $50,000 planned capital, which is actually the entry capital is usually a little bit less. If you wanted to do this with Russell contracts and IWM straddle, you could go as low as what we would call a $10,000 planned capital, where you would use 3 contracts of the Russell and 2 straddles with IWM, and you could do that for a $10,000 position, and that would give you a size that's 1/5 the size of what we're showing here. All right, let's see here. Next question. On the June V Condor, would you consider taking off the call spreads at this point, or is this something you typically would not do for this trade? I could put an order in for 5 cents, or maybe they usually won't take 5, but like 7 cents or something like that, and close it. I would have no problem with doing that. Let's see, what is the spread now? Right now, our calls are priced out at, yeah. So in theory, right, and this is just some mispricing too. In theory, we would make money if we brought back this vertical. So if I could do that, I would do that. But the reality is they won't give you that. It's going to cost you a minimum of 5 cents, and usually they won't even do that. I mean, usually they're going to want 7 or 8. So if you wanted to pay the 7 or 8 cents to get rid of this risk, that would be up to you. For me, I really wouldn't be even concerned about it. I mean, the chances of us hitting this is very, very minimal. But yeah, I mean, if you want to close it for 5 cents, there's certainly nothing wrong with taking the risk off. With this, let me say this though: if I did take this straddle out, I would be decided to sell off this straddle like so, and I was in this position, and I could close these for 10 cents, I would probably definitely be up for that, because that's a little bit different. Because now I'm a little bit more risk of that happening. I don't have the call to offset that. The chances of this actually being a problem with the call in here is just so minimal at this point that I wouldn't even be concerned about it. But like I said, you get up here, we pull the call out, then that becomes more of a concern, and now I'm taking risk for really no reason. So then I might tend to close it. All right, so for the entry, will I roll down half of the put flies if we go down past 1080, or would you wait for 1070 or 1060? What do you have planned with the thought we might bounce? Back to M3. Nope, that's the wrong position here. This is the one we're tracking here. Okay. Generally, with an M3 trade, I don't like the market to, there's 2 reasons to roll a butterfly back. I mean, one of them is 100 delta, which we don't actually hit till about 1070. The other criteria I usually have is because all my risk is to the downside, if I'm super conservative and I am trying to learn a trade and my goal is to not lose money, then I like to roll this back when I get past my short strikes. So basically anything under 1080, I'd roll this thing back. I will still be up some reasonable amount of money here. I'd roll it all the way back probably to, it would be back till at least 1060, maybe even to 1050, at which point when I rolled this back, I would do it in a manner that would completely flatten my T+0 line. So basically on a bounce, the market could go up forever, and I wouldn't lose money. So and in the same process, the significant down move, I still wouldn't lose money. So from that standpoint of not losing money, which is what the trade is designed to do, is have you be able to set a position where you don't lose, that would be the thing to do. You roll back 1050, maybe put a couple of verticals in here, completely flatten your T+0 line, the market continues to go up, you just completely take off your upside risk. Challenge with that is you don't make any more money if that is to happen. Of course, if the market continues to creep down, you'll definitely make more money, which is a good part of that. But we have been experiencing these large bounces, so in that case, you just simply wouldn't probably make any more money for the month. From a practical standpoint, if I'm a little bit more aggressive, I'm really not concerned about this till I close down into the 1070 level. So I may hold that. And if I'm fairly confident that some sort of a support level is going to hold and the volatility really hasn't kicked up that much, I may even be interested in adding some puts in here just to decrease my downside risk in case I'm wrong, and let the market just work itself out here, and then just be very aggressive to the upside if the market reverses as far as verticals to really straighten out my gamma trend and stuff. So that's what I was thinking with that. So what do I have planned for this one? Well, this one goes completely by the guidelines, so I would roll back and flatten my T+0 line should the market come back. So that's what's in plan for this one. All right, so the delta is an issue rather than the T+0 line. Yeah, the delta is an issue, and it's both. And this is in reference to the M3 trade. The delta is an issue. And I'm going to add verticals for that, but also an issue is, hey, I have this sag, and the verticals will help straighten that out. Yeah, so as far as in reference to the V condor for a very small size, yeah, that would be 3 RUT and obviously, yeah, 3 Russell contracts and 2 IWM straddles would be the size. 3 Russell contracts, 2 IWM straddles. And you can track it in Option View by tripling your size. So you put 30 Russell contracts on and 2 Russell straddles to track it in Option View. And your actual position would be 3 Russell contracts, 2 IWM straddles. All right, what should we be looking for entering the July bearish butterfly? All right, so yeah, this week we will be entering let's see, we are how many days from expiration now? We will be entering the July bearish butterfly on Friday. We'll be entering the June rock trade on Wednesday. And we're going to put those on, and we're going to put those on as guidelines as usual. If we're doing a rock trade, and the question is, what should we be looking for entering the June bearish butterfly, the July bearish butterfly? There's pluses and minuses. The pluses are the volatility is up and the pricing is decent. And that's going to mean we're going to be able to withstand a very large move in that position against us, which makes it a whole lot easier to manage and a lot safer to enter in general. Any kind of a significant up move, I'd be very, very interested anywhere. I think we talked about this last week. Anywhere in the 1140 area, very interested in doing a bearish butterfly because at that point, even if we run up to this 1200 area from 1160, that's not that big a deal. It is a little risky to enter them here if the market decides to turn bullish and we get a bullish breakout in the SPX and the Dow, because that will bring us up to here, and it's going to be a very rough run. So, you know, it's a little risky, but like I said, if you have the sideways opinion, then go for it. If you want to be as safe as possible, you're going to want to wait for a move to 1140, 1150 before entering that. Other than that, you know, you could do maybe like an M3 type of a position and run from there. As of right now, David, yes, the new M3 trade, the new Rock trade would very likely be put on as M3. We'll do the entry test, but I can't see a situation where the entry test is going to come out to put on an actual Rock trade. The market is still, the market test is still going to show us as too volatile. So in these situations, when the market's very volatile, the Rock trade system keeps you out of these really tight positions or high theta positions that have a lot of price movement risk. That's what it's designed to do. So it puts you in a safer position for the environment. In that case, you're just going to have to take lower yields until the market conditions improve, where it's a lot safer to take a higher number. All right. So that is all the questions that we have for today, and it's 9:30, so it's time to move on. I hope everybody has a great week and an awesome Memorial Day weekend. Make sure to check my blog at walkingyoursuccess.com for the next update next week, and I'll see you in 2 weeks for the live webinar. So thanks for attending, everybody, and have a great day.